can look at the historical facts and think correctly that the historical predilection of the Fed is going to be hostile. So that's why I'm going to use. Can I use the word pissed off? That's why he's pissed off here. That's the way it is. However, that doesn't change the fact that the president is not going to fire Chairman Powell. Period. $100. What did you want? You wanted dinner?
Dinner, 200.
Oh, dinner. Well, that's a high price. I got to put up with you for dinner, Steve. Come on, you're asking for the moon. I'm just kidding. Look, I'll be happy to take any bet you propose.
Larry, we appreciate you joining us today. Go ahead, Steve. You take it, or
I'm not taking a bet. I don't. But the thing is that here's the thing, Larry. Are you saying that the risk of Trump firing Powell is zero?
There is no thing that has a probability of zero, Steve. Period.
But it sounds like he thinks the number is much smaller than the markets are currently discounting anyway. Appreciate it, Larry. Thanks for joining us today. Good to see you. We'll check back in soon. Larry Lindsay with the Lindsay Group. Dow still down about 1,150 points as it weighs all of this. We've got some news on Uber. Deirdre Bosa brings us the details. Deirdre.
Hey, Kelly, Uber shares, they hit session lows on this court filing that says the FTC is suing the gig economy company, accusing it of deceptive practices related to its one monthly subscription service, Uber One. It offers members benefits on delivery fees and ride sharing. We did hear from an Uber spokesperson in a statement saying, quote, "We are disappointed that the FTC chose to move forward with this action, but we are confident that the courts will agree with what we already know. Uber One sign-up and cancellation processes are clear, simple, follow the letter and spirit of the law." Goes on to say Uber does not sign up or charge customers without their consent. Cancellations can now be done anytime in-app and take most people 20 seconds or less. Again, Uber shares, they're down more than 4.5%, and this is another big tech company, not a mega cap, but a bigger tech company being targeted by regulation, by the Trump regulatory administration. Back to you.
Deirdre, thank you. We appreciate it, Deirdre Bosa. Going to take a quick break here. Coming up, two names that have gone in opposite directions this year, Disney and Spotify. Our next guest just upgraded both, says Disney is priced like the sky is falling, but it's not. He'll join us to make the case and talk about how much upside he sees. And as we head to break, the Dow is down 1,160 points, so we're pretty much sitting at session lows. The S&P is down 3.2%, 3.5% for the NASDAQ, and the 10-year yield just hit 440. There you can see it. We're back after this with much more.
This is The Exchange on CNBC. CNBC. Live ambitiously.
What is that? I know that music. Art! Guys, you gotta see this.
One of 5 immersive worlds in Epic Universe, only at Universal Orlando Resort.
Want to make some extra money, but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. My ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
Welcome to Closing Bell. Let's get into the market right now.
Breaking news, market moves.
What it means for your money in the days ahead.
Scott Wapner from the NYSE. Closing Bell, CNBC.
selling off today along with the rest of the tape. You could argue they're outperforming. Disney anyway, it's down 1.5%. Did get some love this morning from Wolf Research, upgrading the names to outperform. In Disney's case on valuation, on Spotify's case on domination. Let's bring in the analyst behind the call, Wolf Research's Peter Supino. Peter, hard to kind of like pick through the wreckage right now, but is that partly what led to your moves here? Welcome.
Yeah, I like the way you introduced our call this morning, domination and valuation. And yes, it's a really tough day to even think about buying consumer discretionary stocks. The timing of this upgrade on a day-to-day basis was about our media preview, which spanned our entire coverage. And we've decided that Disney is closer to go time, so to speak. Disney is a company that has many things going for it at the same time as it's facing real serious economic headwinds. And so we're focused not on what happens after the recession. And there's a few things going on. The streaming business, we think is worth about $35 a share and contributes nothing to profits today, will contribute in the future. And Disney's launched 3 new cruise ships that should contribute $800 million over the next couple of years.
Can we go back to the part where you said we're looking at what happens after the recession? Is that, I mean, should we now, and a lot of people are saying this, and maybe it's true, but it's still something, I don't know, I don't like the idea that it's basically inevitable at this point.
Well, I'm not an economist, and I'm listening to the same voices you are. And it's much easier to start a conversation with investors about Disney by level setting on the idea that maybe we'll just have a recession, and then what?
Yeah.
Disney is one of the stocks that's pricing in a very high probability of a recession. For example, we think in the case of a pretty harsh recession, Disney would earn $4.70 per share. The company's guided to $5.50 for 2025. At 83, with the stock having been 115 2 months ago, we think that downside's already priced in.
I appreciate that, and I can take your point. Instead of arguing about whether we will or we won't, you just say, okay, so we do, and then what? And what about with Spotify?
So Spotify is the exact opposite of Disney from the stock market perspective. Spotify and Netflix have in common that they're utility-like subscription businesses. They charge consumers small bills that consumers pay without thinking about it every month, and consumers get a ton of value from these products. The cost per hour of engagement at Spotify is something like 25 cents for each consumer. The cost of an hour of engagement at Netflix is just about twice that, in the 40-cent range. So there's a ton of value here. This is the last thing a consumer is going to cut. And their growth outlooks, Spotify's growth outlook is just so idiosyncratic. They have a 30% share of global music streaming, which probably has an addressable market of 1.5 billion people. Based on the number of smartphones in people's pockets around the world. So we think this is going to continue to compound.
And finally, the rest of your group, I mean, there's a lot of names in here that are they include our parent company, Comcast. You've got, some of the tech TMT names in here, like T-Mobile, Verizon, AT&T, some of the music, some video game, live entertainment. How do these all shake out in a recession that people now kind of want to take as a base case?
Well, you've seen it in recent stock price action. The advertising and travel/theme park related businesses like Disney have all traded really poorly in the last several weeks. The distinction we make on these cyclicals is there's a type of cyclical you want to own on the backside of the cycle, and that's a theme park. It's a company that has a business that has real high visibility on recovering its normal profit margins and revenue levels. An advertising business, a linear TV advertising business, is just the opposite. You don't know what you're going to own on the other side of the cycle. Elsewhere in our coverage, telecom has traded very defensively. There's been a lot of, I think, flows into that sector that have kind of rediscovered it in the last year, and now it's getting a benefit from the weak stock market. And, of course, the streaming names like Spotify and Netflix are the perfect storm of positives. I guess that's misusing the metaphor perfect storm, but they're both visible and growing in a very unique, independent, uncorrelated way.
Perfect storm of positive. That's another good headline. You've got away with these words, Peter. Thanks for joining us today. Appreciate it.
Thank you.
Peter Supino with Wolf Research. Take a quick look at the mortgage companies. We're talking Rocket, United Wholesale, Mr. Cooper, which is being bought, all under pressure as rates are moving higher again this week with Treasury yields on the rise. The rate on the 30-year fix is just below 7%, just a hair, and it could be higher still after today. We're back in a moment on The Exchange.
Before they talk to Wall Street, they talk to John Ford and Morgan Brad. Closing bell overtime.
The world's second largest economy is evolving fast, and you have to stay ahead.
Very symbolic of the return of that animal spirit.
From policy shifts to tech disruptors, the EV journey has only just begun. IPOs to global trade, booming, making their debut. Sharp analysis for all you need to know about China and its relationship with the world.
We are never short of competitors, so we do know how to compete.
I'm Emily Tan, reporting live from Hong Kong. Join me on The China Connection.
I took my first journalism class in high school. It felt like a superpower. I find it really meaningful to reach new audiences, women, people of color, younger demographics. A lot of traditional financial advice might not take into consideration that people have debt or that rent is so expensive. To me, ambition means taking on new opportunities that take you out of your comfort zone, but help you learn and grow.
On the next Converge, meet rising next generation leaders shaping tomorrow today.
Keep on learning. Never be satisfied with just today's outcome.
It is our responsibility to adapt. However, I think it is also important not to compromise on your values.
Whatever decision we make as a company, we always keep in our mind, what good can this do for our country as well?
Doing good for business and society are not mutually exclusive.
Find out how they're redefining leadership on the next Converge.
I don't like that I call it the Mag 7, but it is down 4% today, with Tesla and NVIDIA leading the declines. Deirdre Bosa brings us more in Tech Check. Hi again, Deirdre.
Hey, Kelly. So big tech, it's not just navigating volatility anymore. It is increasingly getting boxed in, and the fundamentals are increasingly at odds with the headlines. And that is going to play out as we get deeper into earnings season. That could be, and rather, what was thought to be safe and even an untouchable theme, even amid this tariff turmoil, has been AI spending. But a note from this morning from Wells Fargo's TMT team, it cites several industry sources that say AWS has paused a portion of its leasing discussions. Now, if Amazon is slowing down on data center expansion, that could mean that AI spending isn't as safe or as full throttle as thought, and it could raise questions about demand and whether enterprise adoption really is keeping pace with all of the hype. Now, also important, this echoes positioning from Microsoft that it may be digesting leasing deals for data centers. And if 2 of the 3 hyperscalers are pulling back, that could further shake confidence across the entire AI trade. And certainly that is playing out today in the session. Stocks in the AI-powered data center, semi-trades, they're all getting hit hard, not to mention the Magnificent Seven, which are now getting pinched by Trump's policies at home and China's increasingly competitiveness abroad. Now, this certainly raises the stakes, Kelly, for Google's earnings. That comes up on Thursday. Will it remain committed to its AI spend, or will it give us any hints about 2026 CapEx or even 2025? That will be key for the broader AI trade, which has been hurting this year after sort of only going one way for a long time. And remember, Google is the 3rd largest hyperscaler. So if there's any sort of cold water that they throw on CapEx, that could really hit the entire trade, some of the stocks that are under pressure already today.
Although it's weird, we've had this a couple of times now. Who was it the first time around? Was it also Amazon? Was it Alphabet when we had one analyst with the note? Like we get analyst notes saying Microsoft. Thank you. Now we have an analyst note saying Amazon. What? It's just so there's clearly a little cottage industry right now in trying to figure out if these big tech players are pulling back on their plans. It'd be nice if they just told us, but maybe that's.
I mean, and it's so at odds with what we hear from big tech, right? They say that demand is red hot. They need to keep up the spend, but then you do hear this sort of trickle of news that maybe they're going to pull back. And Satya Nadella, the CEO of Microsoft, even uses words like there will be overbuild. So we do need a clear answer, but it's clearly the markets are reacting to the idea that we don't have one, and it feels like every week or so we're getting some cold water poured on that sort of sentiment that the AI trade is safe or spending is safe. Maybe it's not.
All right, Deirdre, thanks. Appreciate it, Deirdre Bosa. Let's stick with the theme. Our strategist here sees opportunities beyond just the pure infrastructure plays, but still sticking with the AI trade. Roosevelt Bowman is senior investment strategist at Bernstein Private Wealth Management. Did you say Bauman or Bowman?
Bowman.
Okay, the second it came out of my mouth, I was like, wait a minute, I think I just got that wrong. Anyway, thank you for being here, especially in a very tough day like this. And we always hear people say, in the private markets, you're not down 3%, or maybe you just don't know it. But the larger questions about the AI trade, do you have some of these concerns that Deirdre and others are laying out, or do you think that it is full steam ahead for investors?
I think it's full steam ahead, but in a different way. Most of the focus has just been on semiconductors, your cloud computing, the nuts and bolts. And that seemed to be perfectly fine when market volatility was so low over the past couple of years. You could load up and be super concentrated in a few names in those themes. Now, I think with first the DeepSeek news and then now all this market volatility, some of the concentration has been proved quite painful for investors. So that's where you want to broaden out to power, cooling, skill boosting stocks, and then some of those even big box retailers that have a lot of that data, which is the foundation of these models.
But are you looking at publicly traded kind of plays here? The typical set of names that we all talk about, a lot of which are well off their highs, or are these more like private market vehicles?
I think it's both. I think there's still a great opportunity in the public market because I would argue, and we would argue, that the adoption for AI is varied across industries. So some of even the low-hanging fruit of just seeing more small and medium-sized businesses incorporate AI into their processes means the public names can still thrive outside of just semiconductors and cloud computing. But there's opportunity in the private world as well when you think about data centers and those types of facilities.
It makes me nervous. It makes, because you sort of think, well, in the long run, what are the kinds of companies that are going to have like really great, I guess, moats, for lack of a better word, or really durable businesses that don't get quasi-commoditized over time? Like once the initial gains have been made, these stocks are up 300%, the last couple of years, that kind of thing. But now that it's so owned and now that they're struggling to perform, will that magic ever come back?
So I think it will, but in a different shape. So, you think about a moat, right? I think one of the big moats, to go back to the big box retailers, is having all of the information and data. That is very difficult to replicate in any efficient and cost-effective way. So if you have all that data about where your customers are buying goods, when they're buying it, where your trucks are going, you can use machine learning and AI to optimize your sales and distribution process, and you're not paying anyone for the basis of the model, which is the data.
Yeah, no, I don't know if you can name specific names or if it's just, kind of go figure it out and do the research for yourself here. But
I think it's the sort of normal big box retailers that you would expect that, are usually selling to your small and kind of medium level income consumers. They're going to do quite well because they have tons and tons of information about consumer behavior.
And you're also, it's not that like this is the only kind of game in town for you. You're also looking at healthcare and some of these other areas.
Yeah, for sure. I mean, for us, I think healthcare is both a dual play of playing into the slowing economic growth that we're seeing in the U.S. and anticipate abroad as well, and being more defensive. But it's also that I would put healthcare in one of those industry buckets of, hey, we've seen some adoption. Drug discovery certainly has been well reported. But there's so much that can be done in terms of transferring information from patients to caregivers and improving that process and patient outcomes. So it's a lot of low-hanging fruit there.
All right. Roosevelt, thanks. Pleasure to have you here. We appreciate it.
Thank you so much.
Roosevelt Bowman with Bernstein Private Wealth. And check out the healthcare providers. Speaking of which, before we head to break, the iShares ETF is down about 4% today, but down 12% over the past 5 days on some big selling activity. Obviously, we saw United last week. Got Humana down 7% today. Tenet and some of the hospital names taking it on the chin as well. Acadia Healthcare down 13% for a sector that's been under pressure, continues to struggle. We'll have more coverage of this market sell-off after the break.
Singapore is deeply invested in the growth of Asia. We believe that Singapore will do well when our region does well.
The debt issue. We have a very severe supply-demand problem. That's a big deal.
And if you can't put the what and the how in a consistent, clear, and meaningful way, then you could end up with high levels of volatility and conflict.
No American voter will ever accuse Donald Trump of being weak on China. The largest government, the largest economy, the biggest capital market in the world is now holding Bitcoin.
Sponsored by
Good money.
Everything seemed legit until it wasn't.
Good times
The lavish lifestyle, the houses that they're used to.
is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fell for them.
I believe in getting justice.
American Greed on CNBC.
Welcome back to The Exchange. I'm Pippa Stevens with your CNBC News Update. The first of many public ceremonies to celebrate the life of Pope Francis getting underway in St. Peter's Square at the Vatican right now. The recitation of the Rosary, which is a meditative prayer, began just minutes ago. The Vatican announced the 88-year-old Pope's death early this morning. He's expected to be laid to rest in the next few days. The Trump administration is threatening future approvals for federal funding of transportation projects in Manhattan if New York City doesn't end its congestion pricing program. The threat comes as the MTA is still charging the toll for motorists driving into parts of the city after the Department of Transportation gave an April 20th deadline to end it. And Homeland Security Secretary Kristi Noem confirming her bag was stolen Sunday night while eating dinner at a restaurant in D.C. According to CNN, the thief got away with about $3,000 in cash, along with other items, including her driver's license, passport, and work access badge. The Secret Service, which guards the secretary, is investigating. The Exchange will be back right after this.
Before I go out, for me, the more relaxed I can be, the better. As soon as I try and create that situation where I'm tense, I'm like, okay, something big's about to happen, I need to do this. That's when I just don't perform to the level that I need to. And maybe that works differently for other people, and other people, you know, they go and have a kick with a football, or they go do some boxing and they get hyped up. You see their warm-ups, they're getting sweaty, and I'm just lying there having a little nap.
I can't believe that landed. What, you can have a nap before?
I'll have a nap. Yeah, it's like the lower my heart rate, the better I'm gonna do. Because when I get in the car, you know, as soon as the helmet goes on, you're in your own world. It's me, it's my car, everything's disappeared, and it's just you have to focus on what's ahead of you. I'm still nervous, I'm still crazy nervous before races. I'm an overthinker, so I think of a lot of stuff. So the more I can almost calm myself down and just think, okay, all I got to focus on is the start. Then after the start, the rest will happen.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weekdays.
Welcome back to The Exchange. CNBC's newest subscription streaming product is CNBC Plus. It launches today, and we're taking a moment to show you exactly what it looks like. You can see here around me. CNBC Plus data feed shows enhanced data and the latest headlines during our live programming. You can also stream this show and any of your favorite CNBC shows anytime, anywhere I'd get an even closer look at the 1,200 points the market is down today. Tesla shares are part of this. They're down more than 7%, one of the worst performers on the S&P. They report after the bell tomorrow. Let's bring in Phil LeBeau with more details as we'll start to hear from the other automakers soon too, Phil.
Yeah, and Kelly, the Q1 results, that's a little bit of what people will be watching, but more importantly, it's the commentary about the second quarter and the remainder of this year, what's going to happen with tariffs, what's going to happen with trade policy. So as you take a look at the automakers, and yes, it starts tomorrow, you get Hyundai tomorrow, and we also get Tesla after the bell. Was there a sales boost in March because so many dealers said, yes, we'll take as many as we can get before the tariffs kick in? Also, what are the plans for managing tariff impacts? We've heard from a number of automakers saying we're not changing MSRP, maybe for 25 models, maybe through the end of May. Will there be greater clarity there? We do know that a number of them have already said, look, we're looking for ways to add U.S. production, either by maxing out capacity or seeing if they can add some shifts here or there. No comments yet from any automakers about adding actual production plants. Meanwhile, when you look at Tesla, the question tomorrow will be, what's the guidance for the remainder of this year? Remember, Q1 deliveries fell by 13%. Also, will Elon Musk, during the conference call, signal that there is an end date for his work with the Trump administration? And speaking of the Trump administration, all of the automakers will be facing questions, especially the domestic ones, regarding U.S. production. The White House is pushing for more U.S. production. Can they add it? As you take a look at shares of GM, Ford, and Stellantis, keep in mind that auto prices, especially domestic auto prices, will be in focus. And it's going to be an interesting couple of weeks, Kelly, to see exactly what we hear from the automakers. I think investors may not be satisfied because I think what you're going to hear from executives is, well, we think we're planning this, but we're not entirely sure what's going to happen with the policy coming from the Trump administration.
No, I understand. How can they know, right? Unless they maybe they have special information.
I don't think they have special information. I think they all have lobbied for what they think should take place, whether it's with their with the OEMs, the automakers, or with the suppliers. And there's been some progress on certain areas, but we've yet to see something definitive from the Trump administration, aside from what they put in place in terms of 25% tariffs for those vehicles built outside of the United States, with some exceptions for those that are USMCA compliant.
Yeah, no, I heard about it. We were on the Ford lot the other day. I was hearing about it firsthand. Very interesting. We'll talk about that another time. Phil, appreciate it for now. Thanks, Phil LeBeau. Stocks are near session lows. As I mentioned, we're down 1230 on the Dow, and we're down for the fourth straight session for the Dow and the NASDAQ. And even the muni market has been shaken by this recent turmoil. Let's bring in Dan Close. He's Nuvine's head of municipals. Describe what it's been like the last couple of weeks. Welcome.
Kelly, great to be back. It has been a really tough time for the municipal market. We've dramatically underperformed the Treasury moves. Even though fixed income has backed up, the municipal market has backed up even more.
Is China selling munis? Is that what's going on here? Why the underperformance?
You know, it's most of the ownership is with individual retail, so a lot of the underperformance has nothing to do with the fundamentals. Fundamentals continue to be very good. Municipalities aren't really involved with tariffs. They're not making anything that's shipped overseas. They're not importing. So a lot of the volatility we're seeing is just a lack of liquidity and a lot of supply in the market.
And that's why it's so interesting, because you can almost look, same thing happened during COVID, and say if a market like munis, where the fundamentals, if they change, are going to change in a very long time horizon, if that's kind of where you're seeing the traces of the broader liquidity problems in the market, it just kind of tells you how deep they run. We're nowhere near as bad as we were during COVID now, though.
No, and you know, if you look back at COVID, that had a little bit of a whiff of credit related to it. The same with 2008. But what's been fascinating in our marketplace is we've now gotten cheap enough that we have crossover buyers coming in, buyers that don't need the exemption, that are saying, I could have a higher yield than Treasuries. It could be tax exempt. I don't plan to stay in the asset class for too long, but I'm going to come over and buy in this asset class because it's gotten this cheap.
The only thing I wonder about is a little bit of the credit issue, as we're seeing now kind of they're trying with the budgets, they're trying with Medicaid, they're trying, you know, and those, I mean, all of us probably live in towns where the newspapers are full of these stories about we're going to have to raise taxes because this federal program is sunsetting, or we're not sure what's going to happen when these, you know, subsidies go away. So I do wonder about that.
Yeah, there is some. I mean, if you look at a state's budget, the two biggest items are K through 12 education and Medicaid. So if that is cut or does not grow as fast, depending on how you look at it, that could really have a meaningful impact on state budgets. But, you know, there are a lot of different municipal sectors, you know, the have and have-nots, higher education, certainly with student loan cutbacks, with NIH grants. You know, we're very cautious about those, and especially those that are the smaller, tuition-dependent liberal arts schools that don't have the large endowments. You know, it is certainly something that we're navigating through, and one needs to be careful
It's
of.
a great point. As you mentioned, I'm like, geez, where do I go in munis for something that's not under siege right now?
No, and certainly there's a lot of very, very good options. We're looking at, in particular, water and sewer credits. One of their biggest expenses are consent decrees to go in and to put through new pipelines, let's say, and they really don't have as many in this current administration. So your essential service monopolies are going to continue to do very well. Your water and sewer credits, you're going to continue to pay your property taxes. And of any markets, this is one that really can go in and avoid a lot of the the tariff tantrums.
I think
that we
you've
have.
perfectly encapsulated the market today, which is you go to water and sewer bonds because that's the only thing where people feel a modicum of safety. Dan, appreciate you coming back in. We
Thank you so much,
appreciate it.
Kelly.
We'll check back in soon. Dan Close with Nuveen. That does it for us. Thank you for watching The Exchange, and we'll pick up coverage of this market sell-off with Brian Sullivan and Power Lunch right after this break.
CNBC. Live ambitiously.
Would you pay for luxury travel? A week's stay costs almost $270,000.
It's on the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that money can't buy.
This is First Class, only on CNBC.
Another big sell-off for stocks. Every sector in the market is lower by 2, 3, or more %. Energy coming out of the energy and AI trade. And President Trump ramping up the name-calling on Fed Chair Jay Powell. Hi, everybody. Welcome to Power Lunch. Kelly is back, as you can see, from Squawk Box duty, and I am Brian Sullivan. Welcome.
Thank you. And let's look at the markets, which are very unwelcome on this Monday afternoon. The Dow is down 1,270 points right now, so we're at session lows. And if we close here, it will be the 11th 1,000-point drop in the Dow's history, and it's the 4th this month. Now, the S&P broad market, here's what you need to know. Down 3% and down 16% from the 52-week high. We're about 200 points above the intraday low of 49.10 on April 8th. Keep these in mind as people look for a retest, and is that an entry point? The Nasdaq is the worst of the major averages, led lower by Nvidia and Tesla. Tesla down 7% ahead of its earnings tomorrow. And of course, check the yield on the 10-year, because unlike most previous stock sell-offs, where you at least get some cushion here, nope, not getting it today. 440. This time treasuries are being sold as investors sell stocks as well. Dollars down, yields are higher.
All right, so let's stay right there with the markets and your money. It is easy to forget, but the S&P 500 crashed just 3 years ago. It fell 27% at one point in 2022. But it wasn't like this. In 2022, the sell-off was fairly slow, with stocks getting sold piece by piece from January to October. This time, the selling is quick. It's one of the fastest falls since COVID first hit, and before that, the subprime crisis. So let's talk about all this, where it goes and what's really going on with Anderson Capital Management CIO Peter Anderson and Oppenheimer Head of Technical Analysis, Ari Wall. Peter, I'm going to start with you. It's easy to forget that in 2022, the markets fell 25% because it was kind of slow and, dare I say, orderly. This feels different. What are you advising your clients to do right now?
Well, of course, it feels very different because, it was simpler then. I hate to say that. It was very painful, but it was simpler because we were all focused on one thing, the Fed raising rates. That was the theme for the year. This year, too many variables.
The deal. What if it's not resolved, Peter? What if we're still talking about this in June and July and August?
Yeah,
What then?
Well, we still could be talking about it, and not that it will be totally resolved, but we should get some clarity. I mean, if this pressure continues, everybody in the administration. So far, they've been pretty much mute about this reacting to the markets. But my sense is at that point, there will be some kind of acquiescence or giving in or changing course, because we know that the administration takes a very serious read on equity markets, almost in a vanity sense.
Ari, jump in here, especially as we mentioned a second ago, we're getting back to almost the lows of around 4,900 on the S&P. Technically speaking, does that interest you?
In terms of levels and durations, how we think of these setbacks. First off, let's go back to 2022. In hindsight, it was short and orderly. Rest assured, we were all scared. You turn on all these financial broadcasts. There was no more certainty than there is the uncertainty now. People were worried about runaway inflation. The point being, we've seen this before. We've seen these declines. They all play out the same way. And I think that how we're thinking about it is that we've suffered kind of what you would typically suffer over a 7-month time period and only 2-month time period. And what that argues for is that we need more time. I don't think this is through just yet. But with that said, there's going to be ebbs and flows along the way. I think April 7th, that was the high intensity low. At least that's the point when I think a lot of stocks bottom, when downside acceleration is greatest. Typically what happens next, you get a test of that low. You're going to be looking for signs that selling is becoming less bad. The VIX isn't going to be as high as it was. And that sets the stage for the counter trend rally that I think we could see into the summer. I think that 200-day average is going to limit upside. And I think, again, thinking longer term, we're not out of the woods just yet, that there's going to be additional volatility shocks in 2025.
But it's interesting you're saying that kind of time trumps levels, right? So some people would look at this and go, hey, great. We sped up a 7-month sell-off in a 2-week period of time. Now I can get in and not have to worry about it. But your point is more, no, like these things still are going to take a while to work themselves out.
That's right. Typical, we came into the year with below average market expectations just because we were pushing into the third year of this bull cycle. Now, as you think about the down cycle, typically they'll peak to trough last about 7 months. This one's only lasted about 2 months. Typically, you'll see a retracement of 18 months of prior performance. We haven't done that yet. So there's a time element. You even think about 2022. We did a lot of downside in those first few months into May, and then really from May to October was the time element of it. So again, it could look like 2022. I guess the point being is that we have greater conviction, more time is required here rather than necessarily significantly lower levels. That was a 50% retracement of the prior bull market, 4,800. I think that could at least act as the lower end of this kind of range-bound action that we're expecting.
Yeah, and Peter, 2022, we're coming out of COVID, obviously. There was a lot of other things that were going on. This feels different, like I said at the top. How do we get out of this? Do you view this as a self-inflicted market wound?
There's always opportunities, even if, however you define this. And so we're not just sitting here waiting for the storm to pass. I mean, we're looking for opportunities. So one free gift that the market has given us, in our opinion, are international European aerospace and defense companies. They seem to be totally independent of executive orders, tariffs, et cetera, and more focused on the European rearmament defense buildup. So while we're waiting for this storm to pass, there are opportunities, and I would say that, in our opinion, is a very strong opportunity right now.
Yeah, we've talked, Peter, a lot about this stimulus for Germany and stimulus for Europe.
Yeah.
Some would call this the, quote, sell America trade. Are you that far?
Not at all. Instead, I'm looking at broadening the horizons and the fact that American policy has, in part, created this opportunity. We remember that the current administration's attitude toward NATO has fed this. We've been watching the GDP growth of the NATO members prior to Trump's election. It's always been under 2% of their GDP. Remarkably, in November, it broke through that 2% GDP spending level, and so that triggered our interest in those companies. Before then, we really were not paying much attention to them at all. So there are good things that come from uncertainties right now.
Do you, we've did some news here, Peter, but do you worry about what's going on between the president and the Fed chair, or whatever could happen with the Fed here in kind of the direction that could go? Or is that another thing that you think we will be talking less about in 6 months? Because that one you wonder if we're talking about even more.
Right, we're hoping that. But, history, if you do look back, I'm not much of a proponent of saying, history repeats itself, et cetera. But this isn't the first rodeo that has been like this, right? I think all the way back to President Nixon, there have been these public and private disputes. This one does seem over the top, but I do think that it might be some saber rattling and that the current Fed will play out the term.
All right. As I mentioned, we've got some news to get to. Gentlemen, for now, thanks. Peter Anderson, Ari Wald. Megan Casella is at the White House. Megan, what's happening?
Hey, Kelly. So a White House official confirming to me just in the last hour or so that top officials from Target, Walmart, Home Depot, and Lowe's will all be right here at the White House this afternoon for a meeting with President Trump. Now, we don't have an exact time for the meeting. I was told simply mid-afternoon. And we don't know exactly who from each company will be attending. We are expecting most, if not all, 4 of the companies to send their CEOs. But the official I spoke with mentioned that some of them may be top representatives instead. Now, I was not given any details on what exactly the meeting will focus on. I was actually told they've been working to get this scheduled for weeks, meaning since before April 2nd, when that 10% universal baseline tariff and the country-specific tariffs had been rolled out. But we can, of course, expect tariffs to be top of mind for each of these retailers, all of them dependent to varying degrees on imports from abroad. And remember, guys, the president has said that he would be open during this process to talking to companies about the tariffs, potentially looking at some exclusions here. So we do expect to hear more about this meeting after it happens today. We'll bring you guys more, of course, as we have it. Guys.
Okay, Megan, thanks. Megan Casella. After the break, the president wrapping up his attacks on the Fed chair, demanding lower rates. Fears that he wants to fire the chair are spooking investors today. We'll discuss it with former Dallas Fed President Richard Fisher right after this.
One Partnership is bringing technology and modern farming together to advance agriculture and feed a nation.
We are starting with an automation platform. So a system which is controlling relevant machines, processes.
This is our prototype for the precision nutrient injector that interfaces with the Siemens platform that we're building. We're able to store over 100 different types of recipes. And on demand, the machine will actually mix it up and then deliver it to any Go bids.
It is in the same moment giving remotely access to Artisan Green at any point of time. They can see what is the status, what is their energy consumption, what is their water consumption.
The Energy Manager module from Siemens allows us to monitor the equipment, and with that we're able to make sure that the equipment's running at its 100% efficacy, and as a result, electricity costs that way.
Sponsored by
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
I see ambition as enriching your entire life, your financial life, your personal life, and the lives of people around you, your community. My ambition is to build people up.
Scott Wapner from the NYSE. Closing Bell, CNBC.
Welcome back. As the market sell-off continues, the president is increasing the pressure on Fed Chair Powell to lower interest rates. Last week, Trump hinted at the termination of Powell before his term expires. Earlier on Squawk Box, Federal Reserve Bank of Chicago President Austin Goolsbee weighed in on the importance of the Fed's independence.
I agree with the Secretary of the Treasury when he said Fed independence is a jewel box that we don't want to mess with. All economists, I've been at the Fed for a little over 2 years, Before I was ever at the Fed, I would tell you, economists are basically unanimous that Fed independence is critically important. And to see why, just look at the countries where they don't have Fed independence. Inflation is higher, unemployment is higher, growth is worse.
Let's now bring in Richard Fisher, the former president of the Dallas Fed and a CNBC contributor. It's great to have you here. I don't know if you caught Larry Lindsey's comments last hour, but he kind of hinted that the Fed had been hostile toward Trump or towards the GOP versus the Biden administration, so that there might be some history to settle here, Richard. But one way or the other, do you think the president would actually try to terminate the Fed chair before his term ends in May?
Well, first of all, I don't think the Fed's been hostile to the administration. I mean, the one thing you don't want to have happen is for the Fed to become politicized. And by calling Jay Powell names, as the president has done, and insisting that he move, would just, if they were to do it now, it would be based on political pressure, which would undermine the sense of the independence of the Fed. I don't think it's in the president's interest to sack, even if he could, and I'm not sure he can, Chairman Powell. I think the markets, others have commented on this, and I think they're very wise in doing so, that the markets would react extremely negatively. So to me, this is just a way to take away or shove off pressure to somebody else for the consequences we've had of this tariff chaos that we have presently.
Do you think a case can be made for lowering interest rates? The market is at 3.5 rate cuts. So what's interesting about this is it's not even like there's that much of a dispute that you could lower interest rates here. It just seems to be the idea that maybe whoever the president does nominate, and this is where my mind goes, is it more about how high the deficit is, what the Fed might ultimately do or choose to do if there were no other options for bringing interest rates down and so forth?
Well, two observations. First of all, after they did the 50 basis point cut and they did the 3 cuts, interest rates went up. They did not go down. And in fact, they went up 100 basis points on the 10-year. Businesses depend on where the intermediate to longer term bond market is trading. And as you know, spreads have widened as well. So it's not clear, even if they cut, that rates will go down. Our recent experience is the opposite. And I think that needs to be borne in mind. So I'm very concerned about this. I think the president, frankly, is undermining his own case. The impact has been a lower dollar and some dysfunction a little bit, but it hasn't gotten out of hand in the credit markets. And I want to remind the viewers, forget about the stock market. The Fed will always act if the credit markets become dysfunctional and seize up. We did that in 08-09 when I was there, and they did it in 2020 and the COVID scare. So that's what you really are looking for to see whether or not there's extreme damage being done in the system. But to make cuts now, it's like any other business. No business can make a decision right here because the uncertainty has been generated by the executive branch.
So you think, Richard, it's Brian, you think this is self-inflicted?
I do. And I do think, too, again, put yourself in the FOMC shoes. How do you make a decision here where we don't know what the final outcome is or even where it's going? And every business we've listened to, whether it's on CNBC or if we go to the analyst calls, we're hearing the same thing. People cannot make a decision here. Or they're giving alternative forecasts like United Airlines did.
I was just about, Richard, to bring up United Airlines because they're given like, these two, and if people didn't see it last week, the CEO of United went on with Phil and he said, well, here are my 2 forecasts for earnings. They're wildly different because he doesn't have any idea what's going to happen. Companies cannot operate that way. You are in Texas, obviously capital, the energy trade, that's not going well. AI, that demand appears to be starting to slip as well. Take a guess then, Richard, why do you think we are doing this to ourselves? Is there some part of this strategy that to you as a smart guy is like, this must be the 4-dimensional chess we're playing, because nobody I'm talking to quite can figure it all out?
I'm not sure about the smart guy, but thank you for that. But I do think, look, obviously Navarro and gang have captured the president's mind. I believe they're doing damage to him by not advising him properly. I do think our Secretary of the Treasury is the adult in the cabinet. And, you should know also that he hears from former secretaries going all the way back. Anybody that's still alive is happy to advise him. We went through a similar situation when I was the assistant to Secretary Blumenthal in the Carter administration. And he had to go in and tell the president, look, what you're saying is really hurting the dollar. We're getting close to a dollar crisis. You have to change your tone. And Jimmy Carter did it. I happened to accompany the secretary for that meeting in the Oval Office. But after a while, one thing that's interesting, I hope this doesn't happen to Scott Bessent because he's outstanding. After a while, when the secretary kept warning the president, finally the president just fired him. Blumenthal was out after 2 years. This Secretary of the Treasury is sophisticated and important. And if it's true that he did talk to the president and got him to delay at least 90 days, that shows his influence in the dialogue. And if it's true that they had to get in there when Navarro wasn't there, according to the press, that also tells you where the maladvice is coming from. So yes, in that sense, it is self-inflicted. And I hope they give us some clarity. There's a lot that President Trump wants to do that he's doing well. And this is the one big stone around the neck of the markets, of the presidency, and of the economy presently. The Fed cannot fix it, by the way. That's not the Fed's job.
What could happen here, Richard? If let's say he doesn't remove him, could he demote the Fed chair? Just curious how that would actually work. If there's a new chair come May and the rest of the committee doesn't agree with them, could they be outvoted? There's a lot of different scenarios now.
There is a history here. Remember, Volcker was outvoted at the beginning, but Miller had done such a bad job or was so weak. Nice man, by the way, G. William Miller. They moved him over to the Treasury. I wrote the transition memo, by the way, as a young man during that administration.
Wow.
And they put Paul Volcker in there. And then remember, the governors voted against him for a while. And then he prevailed. There's another lesson here, by the way. Ronald Reagan tried to impeach Paul Volcker. People forget that. He sent George Shultz, the most capable man on the planet, and Jim Baker, the other most capable man on the planet, up to the Senate to try to rally a vote against him to impeach him, and Volcker outmaneuvered him. The Senate also does not want to see a non-independent Fed, in my view. And I don't think they're going to acquiesce to a future appointment or an interim appointment or whatever it may be of someone who they view is just going to be politicized and go along with any president.
Because they need 50 votes, to confirm.
They need a little more than 50 votes. That's correct. And we'll have to see. But I hope it doesn't come push to shove, because if it does, we're going to have even further market turmoil, in my view, further spread widening, higher interest rates, and a lot of pressure, which is damaging to the long-term confidence of our economy.
And Powell has got a year left. I'm sure that the search for the new Fed chair, if it's not already on, will be soon. 9 more meetings to go. Richard Fisher, former Federal Reserve President of the Dallas, Texas Federal Reserve. Richard, thank you. Great insight.
Okay, thanks so much.
All right, let's go to another city that also has its own Federal Reserve. That is Chicago. Rick Santelli joining us now to talk about something Kelly just hit on, which is the bond market reaction and moves given everything that is going on right now. Rick?
Yeah, I know you're always paying very close attention to the 30-year bond, the longest maturity on the curve, Brian. And the last time it closed above 5% was Halloween of 2023. Look at a year-to-date chart. This is fascinating. In January, we did have a yield close higher than we're currently trading. It was around 478. It settled at the end of last year. It rallied, or dropped, the yields rallied to 498. That's the high close of the year in yield terms. And it is significant today that we have a split decision. We have short-dated 2- and 3-year yields lower. Everything else mid curve, 5-year, 7-year, all the way out to the 30-year bond, yields are higher. The curve is steepening. Now, if we look at the S&P 500, Brian, on top of the yield curve 2s to 10s, I think that says it all. Its inverse relationship tells me short maturities, as you pointed out, are basically associated with the Fed, which is looking at 3.5 interest rate cuts. Well, I'm not saying they're going to happen, but that's what the market is seeing. Now, if you consider the long-dated yields moving up, that's pushback. Is it Wrong day looking at debt and deficits? Maybe. Is it looking at the notion everybody's talking about tariffs being inflationary? Most likely. But as Richard Fisher pointed out, it's not getting ugly yet. It's a bit thin before we come into New York. And finally, Fed Fund futures, I've been talking about them. Here's the D's contract. 1 week. You see the price going up? When it goes up, that means investors are buying it, implying more rate cuts. Implying is the operative word. I'm not sure if they're going to run to the rescue, but I agree with Richard Fisher. They will run to the rescue if what we're monitoring in treasuries gets nasty. And nasty means illiquid. Brian, back to you.
But they're not illiquid right now. There's still we don't have a credit issue right now.
Not at all. Not at all. As a matter of fact, once again, I'll say, if all I did was being put in a room the last couple of weeks with Treasury yields only, I would think that the volatility up and down is pretty interesting, but I still wouldn't look at it and say, oh, my God, something's really ready to blow.
Rick Santelli in Chicago laying it out. As always, Rick, thank you very much. All right, obviously a lot to come here on Power Lunch, but first up, a safe haven swap. We've got the dollar down. Gold keeps going up. And what about Bitcoin? What is this all telling us? It's coming up.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Before they talk to Wall Street, they talk to John Ford and Morgan Bradley. Closing bell overtime.
All right, welcome back. We want to show you now CNBC's newest subscription streaming product. It is called CNBC Plus. What you're currently seeing on your air right now is the CNBC Plus data feed. It displays an enhanced view and the latest headlines during our live business news lineup, Kelly.
Look how spiffy and sharp it looks. As we watch,
you look spiffy and sharp.
That's all that matters. As we watch the market selling off, we also want to check in on some broader things. The U.S. dollar, for instance, falling to a 3-year low as the president spat with the Fed chair. Adds to the tariff fears hitting the U.S. economy. That had deficits playing a big role in a lot of this, too. It's kind of what brings this all together. Gold soaring to another record high on the back of weaker dollar. 3,400 an ounce. We punched through today for the first time. Gold is up 30% this year. If that were a stock in the S&P 500, it would be the second best performer behind only Philip Morris. Bitcoin is also finally getting its groove back. It's up 4% today, hit about 88,000 earlier, and now it's slightly off the highs of the day, Brian.
Also lower today, oil and energy. There are some positive new developments about a possible nuclear deal with Iran, with negotiators from the United States working to complete an agreement to end Iran's nuclear program. Those talks taking place in the country of Oman. Now, if the negotiators can work out a deal, Iran may be able to add more oil to the global market. That could send prices lower. If they can't work out a deal, the sanctions may get more enforced, and Iranian barrels could be taken off the market, Kelly, sending oil prices higher. Right now, everything is down, including oil and gas stocks. lower across the board. Exxon, Conoco, Chevron, and more, they're all not only down today, but with those losses, now down 12 to up to 20% down in just the past month.
Yeah. And that's practically an outperformance compared to some other parts of the market. The president's stance on lower rates, is he right? Should interest rates be lowered right now? As I said, the market is pricing 3 or 3.5 rate cuts, so they're kind of on board with that. But what are the bigger questions and implications? We'll ask the head of a major regional bank about that.